Hey guys, this video I'm going to walk you through 4 ways to cut your trading taxes in half. Now again, as someone who makes a decent amount of money by selling options, you can see here so far this year, we're only 29 days into the year that I've made roughly $6,800, that there should be some way to cut my taxes down. And again, I've been able to do this for the last 3 years as a trader. I've learned these rules, these strategies and ways to cut my taxes down. And I save as much as $3,000 every year just by using these rules. Anyways, before I get into what these are, let me first say I'm not a financial advisor or a CPA or any tax expert, so please do your own research and contact a professional if you want to use one of these. So let's dive in. The first one we're going to talk about today is we can use Section 1256, okay? This is a way to dramatically cut down your taxes, and it's something that I recommend for all options traders, okay? So what exactly does Section 1256 for futures or SPX means? If we're trying to understand what goes on here with taxes, let's say for easy numbers, we generate $100,000 of trading profits this year. Okay, this is taxed at the normal income tax bracket. So let's say that normal income tax bracket is, let's say 25% is what you fall into. So that means that you're going to pay $25,000 of taxes on this profit that you made. So there's trading profit here, and you have to pay this much. It means you're only going to end up with $75,000 that you get to keep. Now, this is what happens when you're trading options on normal assets. However, you can still use the same strategies that you're using now that work, but you can put them on a different asset. And what I mean by that is if you're trading SPY, instead you can trade SPX. If you're trading SPY or something similar, maybe gold ETFs or something like that, you can then trade the futures form of it. So ES or MES for smaller accounts, or maybe crude oil futures, something like that. You could trade the options on those assets instead. So the Section 1256 rule refers to futures and SPX. And so if you do that, you get to dramatically cut down your taxes by 60% basically. So this is how it works this way. Let's say we have a $100,000 profit. We get to split up how much each tax pays. So it's called a 60-40 split for the 1256 section. So basically what this looks like is 60% of our profit would be 60,000. 40% of our profit would be 40,000. And so this 60% is going to be taxed at a long-term tax bracket, which for most people is roughly 0% with a high of 15%. So let's say we do have to pay 15% on this. That means I only have to pay 15. And again, I'm doing rough math because I don't know the exact math on this, but it's probably around, what was it, 9,000? I don't know, maybe 9,000, a rough guess for this that I have to pay on taxes here. So instead of paying the whole 25%, I only need to pay 15% on this. And so now this is 40,000, and so on the 40%, I pay my normal amount. So this looks like it'd be roughly $10,000. And so if we add that together, that means with the 60-40 split with long-term taxes and short-term taxes, again, 60% long-term tax, 40% short-term tax, that gives me a total taxes of $19,000. That's a net saving of $6,000 just by changing the asset. If I went from SPY to SPX or SPY to ES, doing the same strategy, I'm still going to have the same win rate, still the same consistency and things like that, because it's the same asset. It's just an index version. So again, I get to save $6,000 of taxes, which means at the end of the day, I get to actually keep $81,000 instead of $75,000. So this right here alone could save you $6,000 depending on how much profit you make. Again, I do this by trading futures options, and because now I also have the greater leverage that comes from futures options, which means I make a greater return, but I also get to cut my taxes down. Now, if we're looking into the specifics here, let's make this screen a bit larger. I did share this with you guys from, I believe it's Green Trader Tax website or something. It was, but you can see here the difference based on where your normal tax bracket is. If you're typically at a 35% tax bracket, this is how it gets broken down, okay? With the blended 60-40, you'll end up only paying a 23% tax overall. That means instead of a 35% tax, you'll pay a 23% tax. That means you save 12% on taxes, which is insane. So again, you can see the different returns that you save based on where your normal income tax bracket is. And so again, doing that alone by simply keeping the same strategy, but changing the asset can do a lot for your taxes. Next is method number 2, avoid the wash sale rule. For a lot of people, they don't even know what this is, which is fine because I didn't know about it for the first 2 years of trading. A washed sale rule refers to what happens when you lose a trade and then you enter back into it. So let's say you had a $5,000 loss on a trade, and then turn around within 30 days, you go and re-enter the same trade because maybe it dipped down and you hit your stop loss and now you see it's recovering. And so you want to re-enter to remake that profit back, right? If you re-enter here, then that means this $5,000 loss gets voided and you cannot use it to offset your taxes. So that means if you make $10,000 on this new trade, the IRS will see it as you have $10,000 to pay a tax on, not the net difference, which is the real difference, which is 10,000 minus 5, because you actually have a $5,000 profit. And instead of paying tax on 5,000, you have to pay tax on 10,000 because it voided this because you entered in too soon. Now, this is called the wash sale rule. If you enter in the same asset or an almost identical asset within 30 days, it voids the loss of the previous trade. Okay. So this could cost you a lot of money. And so what you want to do is move to two different assets. Basically have assets that are similar, but not identical. So you can have SPY, you can have QQQ, which is the tech version of it. Then you can have maybe IWM if you're doing ETFs. Again, if you're doing futures, you can do yes, then you can do maybe CL, and then you can also do maybe GC for gold. And so what you're doing here is you're trading this with one slow, consistent strategy. And so you're doing this, and once you take a loss, you move to the next one. You keep trading this. Once you have a loss, you can move to the next one. Once you keep trading this, once you have a loss, you then roll back to the original one. And now you're hitting different assets and you're trading it consistently. And now you're not overlapping trades. So you never hit the wash sale rule. So now you can take all your losses and count them against all the money you made to actually have a realistic amount that you should pay taxes on. Again, if you're doing futures, the same thing. Start with ES, then go to CL, then go to GC, and then flip around. Again, find the assets you like best. Now, again, if you're going to do this type of strategy where you rotate the assets you do around this reason, make sure that you're using a option strategy that tends to have a higher win rate. Why? Because it's harder to rotate between so many assets if you're taking losses like every day, because you don't have to be rotating and waiting every 30 days. So you want a win rate, I would say 80% plus, and then you can let that run out. Now, a fun side effect is if you're doing a high win rate trade like this and you have a loss, typically it leads to a string of losses. So you get out of the trade and you typically avoid a lot of string of losses. So by switching these assets, it can actually help you out as well. So that's avoiding the wash sell rule by rotating your assets. The next method to cut your taxes down is called the M2M election. This is a tax election you can take on your filing every year when you file your taxes. It's called M2M, which stands for mark-to-market election. What this means, it means that the IRS is classifying you as a trader. So this is how you are known as what is called trader status. And so the MTM gives you this status. And so if it does, now you don't have to worry about the wash sell rule because they know you're doing this actively. And so the wash sell rule no longer applies to you, which is good. So no more wash sale. Sorry, my handwriting is terrible. No more wash sale. You can also write off expenses. So again, depending on how it can be handled, you can write off commissions, you can write off your internet fees, your computer, everything you use to trade, because this is where you generate most of your income. Now, this is a great status to fall into, but it's very hard to classify as this. And again, there is no set standards in the IRS rule book. But basically, if you're doing this, 90% of your income or more, again, this is just my personal opinion. I'm not a registered professional, so please seek one, but 90% of your income, of all your income total, should come from trading. Okay. And this also means 90% of your income, and you should be placing a few trades a day. It should be something that you actively do. So I would say, depending, 10 to 100 trades a week, right? And this is a classification that shows you, hey, I'm an active trader. My money comes from trading. I do a lot with it. And then the IRS can see that. So most trader statuses will only work for people who trade full time as their primary source of income. And if you're doing that if you have a full-time job, you most likely cannot classify as this. However, this is a good classification, in my opinion, for people who have retired and now they're using options selling to generate monthly income. And most of their retirement income is coming from the income generated from trading. And so if you're retired, you can then look into how much this is doing, and you can do trader status, so that you can write off expenses, commissions, things like that. And you can also avoid the wash sale rule. Now, a lot of people won't be able to do that, but that's why we have method number 4. Method number 4 is trading through a business. So when you're trading through a business, you get similar type of ranking as trader status. But when you trade through a business, and by business, I mean you create a dedicated LLC or separate company that you trade through. And so when you set up a separate company that you trade through, you then need to open up a business bank account, a business trading account, and everything is done underneath the business. And when it is, you're still subject to things like the wash sell rule, but now it's being treated and it is a business. So that means you can write off expenses. And so again, you should talk to a professional about what exactly you can write, but you can consider writing off commissions because that's the cost of doing business. You can write off your internet, your home office, things like that. So you can start writing off more expenses because it's what you use as a trader to generate profits. And so an LLC is another way to help you offset your losses with, I should say, offset your taxes with losses in other categories by trading as a business. And so again, if you're going to do it as a business, again, the IRS does look into this. So make sure you're treating it as a business, a separate business entity, separate business bank accounts, separate business trading account, and all that stuff so that it's separate and different entities. Sweet. Those are the 4 ways to cut your trading taxes in half. This is the easiest way by just switching to a different asset. This is something by rotating your assets so that you can actually avoid having incorrect tax amount and having to pay more than you should. If you're retired, look into this. If you're not retired but trading actively, look into trading through a business account. All right, guys, I hope you learned something. If you're someone who wants to learn more about option strategies, option selling, how to retire using options strategies, I share everything I know on this channel. So smash that subscribe button and I'll see you in the next video.